Lender Lady Kathryn here. I thought I'd talk to you about a couple of loan programs and the comparison. And a lot of times clients will either have a conventional or an FHA loan. VA is a little bit different because it's for veterans, active duty, and surviving spouse of a veteran. So I covered that in some of my other videos. But today I wanted to cover the conventional loan program and the FHA loan program. Just different words that we use for loan programs. They're generally always 30-year fixed loan programs. The conventional loan is known for buyers that generally put 20% down. Now that has changed. Conventional loans do have a minimum 3% down, minimum 5% down, depending on whether or not you're a first-time home buyer or not. So those are some of the great things about the conventional loan. Conventional loans can kind of put you in a little bit of what I would call a box. It's kind of a standard vanilla loan program where you should really kind of fit into these parameters. Conventional loans historically don't have a great deal of flexibility when it comes to qualifying, especially if you have a lower credit score and a little bit higher debt to income ratio. So it also has PMI. If you put less than 20% down, technically, you're going to have private mortgage insurance, or PMI, which is the insurance that covers the lender in case you don't make your payment, in case you default on the loan. The PMI calculation, however, is tiered on a conventional loan, meaning if you have 3% down or 5% down and a lower credit score, you're going to have a higher monthly mortgage insurance payment, PMI, private mortgage insurance payment, because the less you put down on a loan, the riskier it is to the lender, okay? On the conventional also, let's say you put 10% down or 15% down and you have an okay credit score, your PMI, private monthly insurance, is actually going to be a little bit less because your risk is less. So that's where the PMI comes into play. Conventional loans, again, are a standard 30-year fixed rate loan, no prepayment penalty. If you have a high credit score, that's generally the box we're going to probably try to put you in first. So that's the conventional home loan program. Now, FHA, which is run by the Federal Housing Authority, overseen by HUD, Housing and Urban Development. FHA is a government insured loan. That's why it does have mortgage insurance premium. Now, what's different about the FHA loan in comparison to the conventional loan is the mortgage insurance on a conventional loan is standard. It's flat across the board, meaning it's not tiered like the conventional. So on an FHA loan, if you put 3.5% down or 5% down or 10% down, in generalities, your PMI or MIP for FHA is going to be the same. Now, why would I want an FHA loan? Well, FHA only requires 3.5% down. FHA has a little bit more flexibility in qualifying. Sometimes it'll allow for a higher debt ratio. Those are some of the things or reasons that I would probably put someone into an FHA loan, especially if you have a little bit lower credit score. Let's say your credit score is 650, 670 in comparison to 700. That's probably the loan program that we're going to try. You may be easier to qualify for an FHA loan, but lots of options. Both the conventional loan and the FHA loan do have down payment assistance programs available. There is also closing cost assistance available. Many options. Both programs also have what we call a renovation piece to it, where you can actually build the cost of a renovation into the loan. You close the loan and do the repairs afterwards. So lots of information, lots of options. This is Lender Lady Kathryn, just here to give you some tips about some home loans. Hopefully some of this will resonate with you as a home buyer, and you'll definitely reach out to me with any questions you might have.